So, how do exchanges work? Exchanges work is if I have money in a taxed annual bucket and I want to put it somewhere else, how does it work? Here at the Impact School of Money, we have talked about different buckets of money. So you have your taxable bucket, you have your tax-deferred bucket, and then we've got our tax-exempt bucket. Okay. Then we also have, that we introduced a little bit later, a unique bucket that's going to be a non-qualified annuity that kind of just is taxed in its own special way. Okay, so just as a quick review, so that we get a nice review, but then it also makes sense as we talk about it. This bucket is taxed. The interest is taxed annually. It's added to our taxable income. Tax deferred is meaning that what we put in is a deduction. What we take out is taxable, and the interest is tax deferred, meaning we don't pay taxes as it grows, as we do here. Okay, tax exempt means on the way in, there's no deduction. On the way out, we can pull it out with no tax. And then depending on the type of account we have, we've got to make sure we pull it out the right way. And then the interest is not taxed as it grows each year. Okay, so that's how the three most common ones work. Wow, that was hard for some reason. And then you have a non-qualified annuity that the money that I put in, I get no deduction for it. The money, the interest in it as it grows is tax deferred, meaning I don't pay taxes like I do here. It defers those taxes so I don't have to pay them as it grows. And then on the way out, it's actually almost like two of these combined. What I've put in already, the amount that I've put in, my basis, I would get with no tax. But then all my interest that I pull out is taxed. But then the money that I put in, or my basis, is going to be tax-free. Okay? So if I take it out the normal way, then I'm going to be taxed. What comes out first, this is a last in, first out, or LIFO, L-I-F-O, last in, first out, meaning that my interest comes out first if I'm just taking regular withdrawals, so I'm going to pay taxes on all of that I take out, not capital gains tax, income tax. Okay? If I do something that is not necessarily something that everyone should do, and it's not the only way to get money out either. You can just take regular withdrawals. But what makes it a little bit different as far as taxation goes, so it's almost like a sub-bucket of this bucket. If you decide to take the money out this way, you can do something called annuitize, which again, older annuities, you had to annuitize. That was basically the way to get the money out. Where now it's not. Regular withdrawals can be taken. There's income riders, all of that. All of this we've covered in previous lessons. This is a review to get to what we need to get to. But annuitization may be a new term for those that are consistent watching this. Annuitization is a new word where basically you're taking control of the money and giving that to the insurance company that then uses actuarial math to figure out how long they think you're going to live. They don't do a health check or anything like that, but just based on mortality tables, they'll say, okay, because we think you're going to live to be 86 or whatever it is, we're going to take this non-qualified annuity and we're going to guarantee you a monthly check for the rest of your life, because really they're predicting that you die at 86 and they think that they're going to win, which most of the time they do. And on a large scale, on averages, they do win every time, or else they wouldn't do what they're doing, right? But how it works in an annuitization payment is an annuitization payment. You give up that control, you give up the money to the insurance company. You maybe have a death benefit where if you die, a certain amount goes to your family. But they do the math. They send the monthly payment. You can't change your mind once you've done it, or done what's called a single premium immediate annuity. Works the same way, a SPIA, single premium immediate annuity. So annuitization, they give you that monthly payment. That monthly payment, and this is a unique sub-bucket of this bucket, is part of the payment is your basis that you put in. Part of your payment is interest. And so you only pay taxes on the portion of the payment that is interest. Where if you just take a regular withdrawal, it's all interest first that comes out, if it's a non-qualified annuity. Then it's your basis after that. Okay? But the tricky thing is you can take a tax-deferred account, IRA, and have an IRA annuity. Does that change the taxation? No, it doesn't. Can you have a Roth inside of an annuity? Yes, but there's no such thing as a Roth non-qualified annuity. That doesn't exist. You can have an annuity that's a Roth money inside of the guarantees of an annuity company or an insurance company. Okay? So those are our buckets and our sub-buckets of buckets. So how do exchanges work? Exchanges work is if I have money in a taxed annual bucket and I want to put it somewhere else, how does it work? Okay? So let's just go through one at a time real quick. If I have money in a tax now bucket, can I take that, which it's being taxed annually? Is there an additional tax if I make a contribution to, say, a SEP IRA, a regular IRA, or a 401k? Okay? No tax consequence there. I already paid taxes on this. I'm paying taxes annually on it. When I put money in here, I don't pay an extra tax. I actually get a tax deduction when I take money from here and I stick it in there. I get a tax deduction. Okay? And I don't pay any additional taxes anywhere else. If I have money and I contribute it to the tax-exempt bucket, this money has already been taxed, so I pay no additional tax going into the tax-exempt bucket. I do not get a tax deduction to put it in, no tax deduction. So no additional tax, but also no deduction. But what has happened now is in both, when I move money from here to either one of these, now that I was paying taxes annually, here I don't, here I don't. The difference as well is I was paying taxes annually here. Now I've just deferred that until later. Here, it's considered after-tax money. I put it in here. It grows with no tax. I'm able to pull it out with no tax. But I did pay taxes on the way in, and I get no, I already paid taxes on my check. I don't pay taxes on the way in. Okay, there's not an additional tax to throw it into the tax-exempt bucket. But now it's able to grow with no tax, but I didn't get a tax deduction. So I'm not able to take advantage of a tax benefit today so that I can get a tax benefit later. And so the question is, well, which is the best one? Well, there's no such thing as a best one. Okay? It's the right tool for the right project. It's the right suggestion, the right recommendation for the right situation. Okay? So let's say I have money in the tax-deferred bucket, and I want to move it anywhere. If you have money in the tax-deferred bucket, 401k, IRA, unless it stays inside, and like I have a 401k, I retire, I want to move it to an IRA, that's still in the same bucket. It's in the same column. So 401k to IRA, go for it. IRA to SEP IRA, do it. IRA to simple IRA, you're good. 403b to IRA, if it's in this column and it stays within the columns, and people are like, well, why would they switch it? Well, because you have different limits and different benefits to different plans. SEP IRAs, you can contribute a lot more than a traditional IRA, right? So that's why you would switch around inside of your own bucket, in that bucket. And it's the same thing here. If I have money in a savings account and I move it to a mutual fund, the taxation is the same. If I have money in a mutual fund and I'm sick of it being there and I move it to a bank account, there's no taxation because it's in the same bucket, just a different account inside of the same tax category. Same thing here, okay? If I move it around inside. If I move it anywhere else, if I try to move money from a 401k to here, or from a 401k to a Roth IRA, or a 401k to a non-qualified annuity, anywhere I move it, as soon as it comes out of the tax-deferred column to go into another taxable type account, I'm going to pay taxes on it. Because I pay taxes when I pull it out of a tax-deferred bucket. I'm going to pay taxes on it, okay? And if I do it before 59.5, I'm going to pay an extra 10% penalty unless I do a Roth conversion. A Roth conversion or a 72T, and you'll have to go back in previous lessons when we have them up, which if you're watching this, they're probably up. If you're watching this in the future, that learning, okay, what's a 72T, what's a Roth conversion? But just knowing that if I pull money out of a tax-deferred account, I'm going to pay taxes on it. Income taxes, it'll be added to my taxes for that year unless I'm moving it to a Roth conversion or doing the withdrawal as a 72T where they waive my 10% withdrawal penalty, but I still pay taxes on it. Okay, I'm not avoiding the taxes. I still pay the taxes. I'm just avoiding the penalty if I take it before age 59.5. Okay, if I have money in this one, say I have money in a Roth IRA and I want to move it to a 401k. Can't really think of any logical reason why somebody would do that, but let's say they did. It's money in there. I just have to take withdrawals potentially and stick them in here if I'm younger than 59.5 and I'm pulling money out of a Roth IRA to contribute it to a traditional IRA or something like that. I'm going to pay an early withdrawal penalty for sure on the money in the Roth, and then depending on how long I've had it, I would pay taxes I would pay taxes on the interest that I take out, and I might pay a penalty on some of it or all of it, depending on how long I've had it, if I've passed the 5 years or not. Okay, I'm really trying to think hard of why anybody would take money out of this bucket and put it somewhere else that would actually be beneficial. I've never seen anybody do it. Can't think of an example, and usually if I can't think of an example and I've never seen anybody do it, it's probably because it wouldn't make any sense. Okay, and so that is basically an exchange from bucket to bucket, and would it make any sense? Okay, and last one is if I have money in a non-qualified annuity. If I have money in a non-qualified annuity and I cash it out and I want to move it here, I'm going to pay taxes because I'm cashing it out. I'm going to pay taxes on my gains before I move it anywhere. Okay, and that's if I go from here to here, if I go from here to here, or if I go from here to here. Very similar to the tax deferred is because that interest is tax deferred. If I cash it out and move it here, here, or here, I'm going to pay taxes on that gain. And if I'm 59.5, I am going to pay a 10% penalty. Okay, now there's a misconception, and I'll end on this. There's a misconception that a non-qualified annuity, because it's the principal that I put in was already taxed, and I'm just taxed on the interest once I take it out, that if I'm 40 or I'm 35, that there is no penalty if I take money out, and that's not true. If I were to throw a bunch of money into a non-qualified annuity and annuitize it, that's correct. There is no 10% penalty because I'm paying those taxes every single year, every single month as they give me that check. So if I'm an NFL player and I get a big fat signing bonus of, $30 million and I throw it into a non-qualified annuity and just have it start spitting out a monthly check, I pay income taxes on the portion I'm taking, but I'm not going to pay the penalty because it falls under just a different tax status. So that's our lesson for today. Moving money from bucket to bucket, switching buckets. Thank you for joining us at the Impact School of Money today. My name's Adam Davis. Grateful for you being on here, and look forward to future lessons. Class dismissed.